Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. Welcome everyone to another episode of Investor Intelligence. Today I have with me once again the Mentor Team Director at the Property Mentors, Mr. Herman Benade. Hello Herman.
Hi Jacob, thanks for having me again.
No worries. Today we will be discussing some common misconceptions around property investing. So let's jump into it. The first one we have here is that buying in your local area is best.
Well, yes and no, right? So first of all, it depends on where you live. I think what a lot of people misunderstand about property, or the reason why most people buy in their local area, it's because it's a comfort thing. I can see it, I can touch it, I can feel it, it's around the corner. What experienced investors will do is they will treat it like a business, and they'll understand that across the country, we've got many different markets at very different stages in their markets. So when we're talking about the property clock specifically, some suburbs might be in the correction stage at the moment. Some suburbs might be going into a boom stage. So really understanding where your suburb is in the property clock should be the first step if you're going to invest in your local area. If all of that makes sense and your area has the right investment fundamentals, then there's no issue with buying your own suburb. The problem is if you haven't looked at what else is available outside of your suburb, and if that decision that you're making in terms of buying that investment property close to you is an emotional decision, 90% of the time you're going to fail by doing that, or not fail, but might not get the best outcome that you could have got at that point of time when you were purchasing a property.
Right. And it comes down to there's 15,000 plus suburbs in Australia. So the likelihood of that suburb in your local area being the best performer is very slim, I'm guessing.
Yeah. Again, it depends on where you live.
So you mentioned you want to make sure you're investing in the area for the right reasons. That's not to say that your local area will be a bad area, but that you should be investing in that area because you've done the research, you know it's got the right fundamentals and it fits into your strategy. Does diversification come into play with that as well? So say you've got a property in New South Wales, will you want to diversify to maybe Queensland or Victoria just to spread your risk a little bit?
Potentially. So most of the strategies or the portfolios that we build here at TPM will have a mixture of property types and locations in them. The reason being is you're not putting all your eggs in one basket. You're not banking on that one suburb performing the way you're hoping that it's going to perform.
Yeah.
So that's one element. I would say though, if you're looking at buying in different states just for land tax and things like that, that shouldn't be a decision maker depending on how many properties you own, because you actually need to own a substantial amount of property for that land tax to start becoming a burden on your overall portfolio.
Right. Just to clarify, land tax is...
It's basically a tax that the government charges every single year that's based on the land that you own in that particular state, and you need to meet a threshold, and once you've met that threshold, there's a percentage depending on which state you're in.
Yeah.
So Queensland recently spoke about including your entire portfolio as part of the threshold. That never went anywhere. So I think land tax, when you've got a portfolio like Luke Harris has, but I don't think it should be a driving factor. Your driving factor should always be population, infrastructure, job opportunities, things that are bringing people to that specific location.
Okay, well, moving on to the next misconception that we have, buying off the plan is a bad idea. I've heard from other people that it can be more risky. Is this the case, Herman?
No. not at all. So we get that quite a lot from people that haven't invested before. Obviously, there's risks that there are delays in development and you might be waiting a little bit longer for that property, or in some cases that property never gets built. The risk to you is that you've got your deposit tied up in a trust account. On the risk side, that is it. That deposit that you've put down is not working for you for the period of the construction or however long they hold it. All of the plan properties have a sunset clause. That sunset clause gives both the buyer and the vendor the opportunity to exit that contract at that date. Why a vendor might want to do that? They might have sold the property 2 years ago. It's gone up massively in price and now they can sell it at a higher price. So they'll make use of that sunset clause. And why a purchaser might do that would be if it's been delayed that long, you might be buying a PPR, you really need somewhere to live, so you might take advantage of that.
Yeah.
Or there's been changes in your financial situation. So on the risk side, the developer is not using your deposit to build the development, right? They legally cannot touch that deposit until settlement takes place. So that deposit sits in their solicitor's trust account. When settlement takes place, their solicitor will then provide them with that money, essentially. Okay. So that's a risk. You're not going to lose any money. On the positive sides, right, and the pros is staged capital growth. That's probably the biggest benefit you could get from buying off the plan. And what I mean by that is essentially if a developer is building 150 townhouses, they might release 20 or 30 of them at a time. And they will need to meet a certain sales quota to get their commercial funding for that project. So that first lot of properties that get sold are typically going to be sold for what they've been put on the ground for. They're not going to be sold at a premium or anything like that. And then as the stages go on, there'll be incremental increases in that price list. And then the developer is going to make most of their money on those last couple of releases, right? Because it's close to settlement, you're entering a whole different market. You're entering the owner-occupier market once it gets close to settlement. So there's more competition. They can charge a little bit more. By that time, obviously, capital growth has happened in that area. So the property is actually worth more. So for a lot of people, particularly if you're following a leapfrog strategy, buying off the plan can be hugely beneficial because you're making capital growth and all you've done at this point is put down a deposit. There's no loan against it. There's no interest that you've paid. At that point of time, if you're using any of our conveyancers, you haven't even paid conveyancing fees. So you're making money by just putting your deposit down. Now, the trick is to get in early in these projects. Because obviously if you're buying at the later end, then you're not going to get that same benefit. So that's one reason to buy it. Another reason to go into off the plan would be, let's say you are a good saver, you just can't save a lot and you need a bit of time to come up with settlement costs. A lot of people think, okay, I've got $50,000, I've got a 500K borrowing capacity, I can go and buy a property now. That settles straight away. You can't. There's stamps, there's settlement costs, LMIs, legal fees, buffers, all of those kind of things that you need to have. So for someone in a position where they're still saving, and we can see that those savings are going to get them in 12 months to where they need to be with the settlement costs, it would be beneficial for that person to get into the market and secure something in today's prices and then say the settlement costs and settle next year, right? And then you get that capital growth, you get all of those kind of things. So those are two reasons. I can't see any issues at all with buying off the plan. Right? The only exception I would say is probably if you're in a high income and there's an option between buying a newly built property that's established and an off the plan property, you probably just need to look at your tax position to see what would fit your strategy better.
Okay, so it sounds like there are a lot of great advantages in buying off the plan. So Herman, you made a distinction between newly built and off the plan properties. What's the difference?
So what I mean by that is we're always going, as part of our strategy, we always look at new property, right? So whether that property is still being built or whether that property has been built, completed, and has not been sold to another owner after the developer has finished it. The reason why we look at that and why I've made that comment is someone on a really high salary, if you've got no tax benefits that you can claim on your income, right, it might be more beneficial for you to look at a newly built property that you can settle on straight away so you can get those tax benefits immediately, and that takes effect pretty much as soon as you settle on that property,
Right.
right? In comparison to waiting a year or 18 months for property to settle, and then those tax benefits won't actually kick in until that property settles.
Okay, that makes sense. So moving on, the next misconception we have is that renting is bad and you should ideally save up and buy the home that you're going to live in before you start investing. Now, we have recently had a podcast doing a deep dive into this exact topic, but can you cover a little bit again on this one, please, Herman?
Renting is not bad. Renting for your whole life and never setting yourself up, that would be bad, because then you'll be renting in retirement. But renting actually, when it comes to your borrowing capacity, can be a benefit because it's not a mortgage. You can always move to a property that's less expensive. So from a bank's perspective, they're less harsh on renting than what they would be if you had a mortgage to pay, because that mortgage is there for the next 30 years. So I think it's really important for people to do their strategies first and speak to a good broker to figure out what it would look like if they bought a PPR straight away, whether they will be able to invest after that, or whether it's better to flip it on its head, invest first and then get your PPR later. But that's really a broker question.
That makes sense. And a conversation I've had with a colleague, Pat, is that if buying your home that you were going to live in meant that you were missing out on 5 years of growth, would you still do it? And I think that's important to think about, because you are essentially putting off investing, and that time in the market, as you've said before in this podcast, Herman, time is the magic ingredient to property investing. And by going into your home that you're going to live in, you are foregoing the time that you could have otherwise in the market.
Yeah, there's obviously conditions around that. Like if you are currently living in a 2-bedroom apartment and you've got 4 kids, right? You need to take your personal situation into consideration when you're putting the strategy together. When we do the strategies, you can ask any of my members. Our main focus is to find a good balance between investing and the things we enjoy in life and the things we need in life, because that's the way you see it through, right? If it's all on the investing side, you're just going to quit.
Yeah.
Here at The Property Mentors, we have decades of experience investing in property. We know what to look for and what kind of impact it can have on your portfolio. We have access to brokers, accountants, and property managers to make sure your portfolio performs. Visit thepropertymentors.com.au to learn more.
Well, the next misconception that we have is the Australian property market is one big market. And often that comes from the media putting out headlines saying the Australian property market has gone down because of interest rates or whatever the case is. Can you talk a little bit about how that's not always the case, that there are markets within markets?
Probably the easiest way, without going, because I know we've done an episode on the property clock before, but to give you an example of a state going through a property clock at the moment, as soon as a state starts spending a lot of money on infrastructure, what that does is it attracts buyers, right? And like I've discussed on previous podcasts, capital growth and property prices are directly correlated to supply and demand, right? So if there's an oversupply of property and there's no demand, property prices are going to drop. If there's an undersupply and there's a high demand, they're going to continue on rising. Now, one area to look at in context with the property clock would be Brisbane at the moment. So they're gearing up for the Olympics, right? As a side effect of that, they're putting in new infrastructure. We're already hearing from a lot of clients that we speak to, oh, we really want to get into south of Brisbane or South Queensland, Southeast Queensland. There's an oversupply of interest in that specific area. Now, what that's going to do is create a boom to a certain extent. Not necessarily because the long-term fundamentals is there for a boom, but because the public has the idea that, hey, the Olympics are there, therefore prices in Brisbane are going to continue on rising, right? So you need to understand that when you're buying in Brisbane, to understand what's happening in that market, to know whether you're buying at the top of the market, bottom of the market, right? So I can't, in the 4 years that I've worked at TPM, I'm not aware of any New South Wales property that we have done at all or presented to people. And the reason being, where New South Wales is in that property clock, it's at the highest point that it's going to be. So if you buy there now, you have to wait for a whole nother property cycle to get that same kind of capital growth, right? So That's what people need to understand about the property clock. But I'm going to bring it back to the fact that time in the market, and I know we've said this a million times, but time in the market is more important than trying to time the market, right?
Yeah.
You really need to get the property, hold on to it for a good amount of time, and then based on history, right, based on what we've seen in the Australian property market over the last 20 years, the same should continue on happening, right? Because we are not fixing our supply issue and things like that. So property clock's important, more so from the perspective that you don't buy at the top of the market, that you don't pay a premium for a product just because there's some short-term interest in that specific market.
Yeah, that makes sense. And I think it's important for the people who are maybe sitting on the sidelines and waiting to really understand this concept. And something that I've learned as well is that there are always opportunities. And as you were saying about the property clock, to go back to the misconception, the Australian property market isn't just one big market. There are markets within markets, and each suburb is going to likely perform very differently depending on what market that is in. So if the demand is there, there's always going to be opportunities in property.
A good way, if you want to try to predict it, I know it's a long and some people might think boring read, right? But there's a Plan Victoria document readily available to anyone that basically plans out exactly what the Victorian government is planning on doing in terms of making that state more accessible, more livable, all of those kind of things. If you can read that, take the time, understand where they are spending money, why they are spending money there, what's the reason for that, why are they adding more train lines? The government's only going to spend that money if they expect an increase in population in that specific area, right?
Yeah.
If you can understand that, that is some really good data for you to have a look at. Now, if you want to compare that Plan Victoria document with any other document from any other state across the country, it doesn't compare, right? So you can see how the markets within Victoria is going to be a lot more accelerated than markets, say, in WA, which is heavily reliant on the oil and gas and mining industry for that growth to continue on. So if anyone wants a starting point in terms of where to buy, that will be your starting point.
Yeah, that's interesting. Well, going off that, we've discussed that not all markets are created equal, but going into a more micro point of view, if we're talking about the same market, another misconception that people often have is that all properties within that market are created equal. And what I mean by that is that if a property is in a suburb, then each property within that suburb will likely perform the same. What would you say to that?
You need to understand what properties are in that suburb, and what we typically look for in a really short answer is the odd one out. Right?
Okay.
So if it's a house and land suburb and there's 1,000 of the same products, right, we want the townhouses. If it's closer to a city and it's a townhouse market and there's a very low supply of apartments, then we might go into an apartment there.
That's sort of counterintuitive, because you would think that because there's a larger supply of a certain property, then there would be demand for that in a way.
So my question to you would be, okay, basically if you look at your 4-bedroom house and land, who's your target market? Who's your client? And when I say your client, the person who's going to rent that property from you.
Yeah, I would say families.
Families, right? Who's going to be your townhouse market?
Singles, couples, younger couples.
Young families, starting off a family, things like that.
Yeah.
Who's going to be your apartment market?
Well, that would be more singles.
Singles, students, young professionals that want to work in the city, right? Each of those groups of people are represented pretty much all across Australia, right? So what we don't want, right, is when your property goes up for rent, the exact same stats, if you want to put it like that, or the 4-bedroom, 2-bathroom, stock standard suburban home, there's 6, 7, 8, 20, 30 of those exact same properties on the market at the time when you're trying to rent your property, right? That's not a good thing in terms of your cash flow, right? You can't have your property sit there empty. It needs to be tenanted, right?
Yeah.
2% vacancy rate is what our property managers aim for across a year. So that's one reason that you're going in towards the specialized product in that market, which means the people that don't want the townhouses, let's say you're single young professionals, right? They are most likely going to live in an apartment. If there's only 20 apartments in that entire suburb, your apartments are going to rent better 90% of the time than the product that there's 100 of. And the same applies for resale value, right? So your chances, if you've got the odd one out in the suburb, right? Your chances that you're going to have a comparative property that sells at a lower rate because of a distressed sale or because someone's overseas and they just want to offload their property that then underpins your property value, right? Reduces because there's not as much of a chance of that happening in that area. But it really comes down to the fact that people need to treat property like a business. And if you treat property like a business, who's your clientele, right? And when you buy that property, is there going to be a reason for my clientele to want to rent my property? Now, apartments like that, right? So I'll use one example from a project that we've worked on before, 11 kilometers away from Melbourne CBD, only apartment block in that suburb. Great accessibility to universities, education, all of those kind of things, sports, all of that, right? So there's a reason why a developer has done all the research, put their own money on the line, because they know there's going to be a need for that property type in that specific area.
Right.
So it's not counterproductive. And then one thing that you probably didn't take into consideration is if you do go into an area and there's an abundance of a certain property type, out of that abundance of the certain property type, how many of those are owner-occupiers and how many of those are investors?
I would say more so owner-occupiers.
Owner-occupier.
Yeah.
Yeah. So they've bought a house that they want to live in that fits their lifestyle. And investors shouldn't be thinking like that. They should be going, I'm buying a house to rent out to someone so I can make a profit.
Yeah. So it sounds like a lot of it just comes down to supply and demand. And if there's less supply, then
There's higher demand.
yeah.
Yeah.
Well, yeah, that makes sense. So moving on to the next misconception, you need to take on debt to invest in property. Now, for whatever reason, you might not be able to get serviceability. So, Herman, can you talk a little bit about some of the alternative ways to invest in property where you don't necessarily need to take on debt?
Well, there's lots. The stuff that we do, we've got a product called Become a Lender, which is essentially peer-to-peer lending. And we've got something called Wholesale Property Trust. Wholesale Property Trust is an invitation-only trust that we run. It essentially has a cap on how much money we can raise in that trust. And there's a cap on how many investors can be or unit holders can be in that trust. And essentially what it does is you buy units in the trust. The trust then leverage the cash from those units to go and buy property. And we keep on leveraging that portfolio at 50% to grow that portfolio over time, the same way you would build your own property portfolio. We just do it in a trust. And what that means for our members is they don't have to go through the lending process. So the trust takes out the finance. But the benefit for the client is your units go up over time because the value of the properties in the trust obviously go up over time, and then you get a dividend paid out to you. So there is other options to invest if you've hit that roadblock where the banks won't lend you any more money, or if you're just at that stage in your life where you just don't want to take on that amount of debt. I will put a caveat to that, right? Both the strategies I've just spoken about wouldn't suit someone that has absolutely no investment experience or anything like that, right? We use it as an add-on for a strategy, not a standalone strategy for our members. So I guess don't call us and say, hey, I can't lend because I've got a bad credit record, or I've not saved, or I've not done any of these kind of things. I want to invest. We still need to make sure that whoever we invite to WPT are experienced investors.
So the next misconception, and we've sort of already touched on time being an important factor in property investing, but the next misconception that we have is timing the market is the best way to secure a deal and ensure success.
Definitely not. Even us here that do it day in, day out, right? It is rare. Not very rare, but it is rare that deals fall on our laps. We can get off-market opportunities and things like that, but the whole concept of a deal in the property market, I don't fully understand that. There's a cost of putting the property on the ground. There's a cost to the land, right? That's what the property is going to cost, plus any profits that people need to make. I guess speaking to because we do get this quite a lot, where people come to us and they want our service because they want a distressed sale, something like that, right? If that's the strategy that you're following, right, you're going to be shooting yourself in the foot. And the reason being kind of goes back on what I've said on one of my previous podcasts, right? There are people way more connected, right, that will be at the front of the line for any sales like that. So just keep it simple, right?
Yeah.
Buy the property, hold it, look at what the Australian property market has done over the last 20 years. And even if it performs at 50% of the rate that it's done over the last 20 years, you're still going to make money.
Yeah. Okay. So I think the biggest takeaway from this and some of our previous conversations in this episode is that don't wait for a deal. Don't wait for interest rates or whatever the objection may be. There's always going to be opportunities within the market. And as you said earlier, time in the market always beats timing the market.
Yeah, 100%.
So our last misconception is property prices have gone up so much in the past that they cannot keep going up in the future.
Do yourself a favor and look at real estate prices in New York, in London. Absolute, I don't know if I'm allowed to say this, bullshit.
Yep, you can say that.
Yep, that whole concept, bring it back to supply and demand. So unless all of a sudden our local governments start getting behind developers and supporting them by allowing more development, removing some of that red tape around developments, removing some of the unnecessary costs around development, right? This problem isn't going to be fixed. If anything, COVID has made that problem significantly worse because we didn't build for a period, right?
Yeah.
So we're still trying to catch up, and we will catch up at some point, but our population will continue on growing. Our immigration policies are tailored in a way where we attract highly skilled labor. We don't really attract low-skilled labor, and what that means is more money, more people with money to spend coming into the Australian market, particularly around renewable energies and tech at the moment.
Yeah.
We're doing a lot of stuff around that. So you can just imagine we add more people to the equation with the money to spend. That supply and demand thing isn't going away anytime soon. In saying that, right, if you go into a property and you expect it to grow the way it's grown over COVID, right, in a couple of years to go up by 20 or 30%, right, just don't get into property investing because that's not how it works. You kind of have to give it the time, and the capital growth is important, very important to us, particularly when we're growing the portfolio, because we need that equity to pay the next deposit, the next settlement costs, all of those kind of things. But the aim of the game is to get your property unencumbered. So when you do retire, you've got property essentially bringing in income for you for the rest of your life. That's the actual aim of the game.
And unencumbered as in no debt, correct?
No debt on it, right? Because if you go into retirement with 90% debt, you don't have a passive income.
Yeah.
You don't own those properties, the banks do.
And I think it's been something that's really helped my understanding, and going back to what you were saying before, Herman, in terms of supply and demand, as you said, population's growing. I think I read a statistic from the Australian Bureau of Statistics. They estimate that the population will go from 26 million in Australia to 30 million within the decade. That's a massive increase, and those people will need to live somewhere. And again, going back to what you were saying even earlier than that, if you know where the population is going, if you're reading these government websites that are showing where the spend is going, that gives an indication of that's where the population is going to go. As I said, they need to live somewhere. So that's going to increase demand for both buying and renting, right? Another thing that I've learned from, Luke, is that there's an incredible amount of support from banks and government. So when banks give out loans at 95%, they're essentially the biggest landlords in the country, and they're not going to be giving out loans of that size if they think that an industry is risky or that property prices are going to come tumbling down.
Absolutely nailed that. What you just said should put most investors at ease, understanding that you're not actually the one taking on the risk. The banks are taking on 90% of the risk, right? In our cases, it'll most of the time be 90% of the risk. On the flip side to that, there's been some recent talk, or not talk, but actually going ahead with it. There's areas that banks just won't lend in anymore,
Okay.
right? So flood areas that are predicted to be underwater in the coming decades, and they won't lend on it because you can't get insurance on it.
Right.
I had this conversation with a client recently who sent us a property saying, oh, look at this property in comparison to the one that you've sent to us, right? Smack bang in the middle of a flood zone, right? A very quick Google search showed us that you can't get insurance on a property in that area, right? So understanding things like that, right? Understanding that there are people way smarter than you, right? Teams of people way smarter than any of us that manage these risks for the banks, right? Should put your mind at ease. If you can get insurance for a property and a bank's willing to put 90% of their money into that property, they are only doing that because they believe that that property's value is going to be underpinned. And it's the same thing as what the government's doing at the moment with the first home buyers to say, okay, well, we'll give you 15%, but then when you sell the property, we want that percentage back of the new price of the property.
Oh, wow.
Right?
Okay.
They are banking, right, because they're using taxpayers' money to give people deposits to buy their own personal homes for personal reasons. So they're banking on the property industry continuing performing the way it is so that they can get a return on that investment, that taxpayers' money that they've just invested on an individual.
Yeah, and that's interesting because obviously they wouldn't be having that clause in there if they expected that the valuation would come in at a lower price.
And obviously they can't say that for every single property that they provide this to, but I'm pretty sure that they're going to have a look at where you're buying, right? And you are only going to get that grant if you meet certain criteria around that property actually performing.
And going back to the bank, they can also influence prices by their lending policies. If they suspect that there's an oversupply in a particular area, they can stop lending to developers and restrict some of that supply coming in, right?
Yeah, we get that quite a lot. Like you go into a specific area, Chelsea will tell us straight up, banks won't lend more than 80% in this area. And that's typically when we're talking about secondary markets, right? So we need to take that into consideration. Again, that's where the plan comes in. But you're 100% right. There is some nuances between what happens in the stock market and what happens with property prices in terms of market confidence. The stock market is pure market confidence, right? So if there's a mass sell-off of a particular stock, that stock's going to crash. If there's a mass purchase of a particular stock, that stock is going to rise in prices. It's the same thing. Like if you make money easy to borrow, right? If you make money inexpensive to borrow, then there's going to be a confidence in the market and people are going to want to take advantage of that. You do the opposite and the opposite's going to happen. The difference between the stock market and the property market is you don't need a stock to live. You need a roof over your house, right?
That's right.
So that supply and demand is always there.
Yeah, and it's worth noting too that around 66% of home buyers are buying to live in the home, not to invest. So when things happen in the market sees adversity, then there's going to be a lot less sell pressure compared to stocks and other types of markets because you've still always got demand. People aren't selling their homes that they're living in.
Jacob, do you know what percentage of Australians are property investors?
I want to say around 8%.
8%.
Okay.
Right? 8% of our entire population invests in property, right? Out of those 8%, only 1% out of the 8%, right, has more than 6 investment properties.
Right.
That's mind-blowing.
Yeah.
Like my question would be, what's happening to the other 92% in retirement? Like we already know we've got an aging population, right? People aren't being born fast enough for us to have a young workforce, right?
Yeah.
So what's going to happen in 30 years from now, 40 years, when all of these people, the 92% that haven't invested, are all relying on the pension, but we don't have a young workforce? Like, this is the stuff that makes me really worried. And it's not just an Australian problem, it's a global problem. There's a really good documentary, if anyone wants to watch it, that's about the rise of Africa, that basically explains around what our population is going to be doing over the next 50 years or so, and where the workforce is going to come from, what aging populations are going to do. These are things, I know it's not directly about property, but it's a question you should ask yourself that you're going to need to retire at some point, right? We know what our government can be like. They can be like a yo-yo sometimes. One way we're going this direction, one way we're going this direction. Every time there's a change in governments, there's different policies that come in, right? Ask yourself the question, do you want to leave it up to the government to dictate what your retirement's going to look like?
Right.
Do you have enough confidence in the market, in the government, to know that they've got a solid plan to actually take care of an aging population?
Yeah. And I think for myself, I would rather take that into my own hands, and I'm guessing a lot of our listeners would like to do the same. With that, Herman, thank you so much for your time and for clarifying a lot of these misconceptions. I learned a lot. I'm sure our listeners did as well. And I look forward to having you back on.
My pleasure. Thank you, Jacob.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.